Well, good afternoon and welcome to another exciting Thursday and the Mortgage Minute. My name is Jeff Harrison. I'm your back behind the scenes host, and I want to welcome you to another show where you get to learn everything you need to know about mortgages and strategies and tips to help you save money. So when you're deciding whether you're refinancing, you getting a new mortgage, maybe you want to take out some equity and maybe make an investment with it or fix it up or put solar. This is a place you want to come because we have a guest, or excuse me, we have an expert with over decades of experience in this exact industry, and we're going to bring him on now. Let's welcome Art Alvarez from MortgageWorks. Art, good morning.
Hello, Jeff. How are you?
I'm great, and thanks for joining us this afternoon. We appreciate that. I think I said good morning. I don't know what I was thinking. Good afternoon. And as you always say, hey, it's morning somewhere. Maybe it's
That's right.
time for another cup of coffee. But hey, there's some good news out there today. I'm excited to hear what you have to say about what's going on in the market and share some stuff. So before I go, I just want to remind you, if you're here watching, please put your comments in, whether you're on Facebook or YouTube, please put your comments in the comment section and I'll feed them into Art. Art will then answer them. But if you're watching it and it's been recorded and you're watching it then on YouTube or Facebook and you have a question or a comment, please put it in the same comment area and Art will follow up with that. With that, Art, I'm going to turn it over to you.
Okay, Jeff. Thank you. Well, good afternoon, everyone. Art Alvarez at MortgageWorks, where we do have the answers and they're on the house. Welcome to this week's Mortgage Minute. As you know, when we start the program, the first thing I like to do is give you an update on mortgage rates. So let's jump right into that. I guess the short version is the good news is rates have improved. And this is interesting. Here's our rate grid on our website where you can see what we have posted for various types of loans, conforming as well as FHA, VA, jumbo, and seconds as well, both HELOCs and fixed rate seconds, what we call HE loans. So yes, rates have been improving. Basically about middle of this week is when it started. And you can kind of get an idea of this when you look at the 10-year bond chart. As I always mention, that's probably your best barometer to gauge where mortgage rates are going. And you can see the chart right there. And that yield, that 10-year yield at 4.08, that's a big improvement from where it was just a week or two ago. As you may recall, it got up into the 4.35 range. So we're down quite a bit. It's going to be really good if we can get back under 4%. So in that regard, what is going on? What are the factors affecting bond yields and mortgage rates this week? Well, the week started off with interest rates and bond yields pretty elevated, back closer to that 4.3 level. And part of the reason for that was last Friday, Fed Chairman Jerome Powell, gave a speech where, of course, he continued the rhetoric of the Fed's going to continue to be aggressive in fighting inflation, that their fight is not over, and that we should not expect that they are necessarily done pausing any increases in the Fed funds rate. So that speech, of course, the markets reacted with yields and mortgage rates remaining elevated. And then as we got into this week, Monday, Tuesday was pretty quiet. However, on Tuesday, we did have the JOLTS report. That's the job openings and labor turnover data point. And that one was an interesting one because it showed a pretty big drop in job openings. Previous to July and June, it was about 9.2 million job openings were out there. Well, in July, it dropped about 8.8 million. That's a pretty big drop. In fact, that is the lowest job opening number since March of 21. So over two and a half years, it's been since the job openings were that low. And the other thing that did get announced on Tuesday was the second quarter GDP was revised downward. It was initially estimated at 2.4% growth. It was revised to a 2.1% growth number for the second quarter. So that indication of softening, the JOLTS indication of softening, that's really has been the driving force of the reduction in the 10-year bond yield and therefore mortgage rates at this point. Today, the core PCE, remember that's the Personal Consumption Expenditure Index. That is the Fed's favorite inflation gauge. And that actually ticked up slightly, 4.2 from 4.1 in June. But what is important when these numbers come out, even in this case with a slight uptick, you would think, inflation is not resolved yet. It's ticking up. But expectations are important. And the 4.2 number is what was forecast to be announced. And so because it was, in fact, 4.2 as expected, the markets didn't react negatively. And as a consequence, you can see that bond yield is still looking pretty good at that 4.08 number that Jeff showed earlier. And then the other thing that's going to be happening tomorrow, important numbers, job numbers, non-farm payrolls, the unemployment rate, and hourly wages. And that can always be a market mover. So you want to take a look at that tomorrow. Look at the 10-year bond yield in the morning when these job numbers come out, and you'll see what kind of impact it's going to have on yields and therefore on mortgage rates. So that's where we're at on rates. Good news, they have improved. By the way, I can't emphasize this enough. When I look at the financial news feeds for the real estate market, the stock bond markets, watch CNBC in the morning to see the business news early. I noticed this morning they said that they show the conforming 30-year fixed rate is at 7.06. Earlier in the week, they were saying 7.25. You shouldn't be looking at 7% rates. We are under 7. So if you've got a decent credit score, putting a decent down payment on a purchase, or you're looking at a refi, it's possible to get a rate under 7%. So keep that in mind. If you're looking at getting a loan and you're talking to a lender and you're being told that you're going to get a rate at over 7% on a conforming 30-year fixed, get a second opinion. Call us, because you can get under 7. If you're a real estate agent and one of your clients is looking to get a loan to purchase a home, if they're being told over 7, they should get a second opinion. Again, you've got to have pretty decent credit score. If you're a 620 score, you're going to be probably looking at a rate over 7%. For your higher credit score borrowers with a decent down payment, which, by the way, that's only 5% down or more, a 7% rate isn't necessary. You should be able to get something under 7. So if you need a second opinion, check us out. We'll be happy to give you some numbers, a worksheet, so you can do some shopping and compare with what you're getting quoted elsewhere. And with that, I wanted to go into home prices. Headline caught my attention this week, and it's pretty interesting. Zillow. There's the headline. Zillow is a full-blown housing market bull, and that was published in Fortune magazine on August 27th, 2023, just a few days ago. And it's interesting because Zillow is now predicting that U.S. home prices are going to jump by 6.5% by July of 2024. What's interesting about that is back in February, they were only predicting a 0.5% increase in home values over the next 12 months. So what's happening there is the fact that tight inventory is continuing to overpower the higher rates. Now, normally higher rates would be believed to be something that's going to moderate home prices, going to push them down because there's going to be less buyers able to afford those higher payments from those higher rates. That's happened to some degree. It has moderated prices. In other words, the rate of increase has slowed, but we really have not seen a dramatic drop in home prices pretty much anywhere in the country. And in that regard, it's now becoming apparent that this tight inventory is going to continue to push up prices rather than seeing them drop. And one thing I would point out is, and I saw this, the Case-Shiller report, which has been around since for quite a long time. They've been tracking home prices going back to 1975. And throughout that period of time, home prices on average have increased by 5.5%. And that includes the big downturn of 2008. So keep that in mind. A 6.5% increase in prices by July of next year is really kind of consistent with what the Case-Shiller average has seen since 1975. And some important numbers came out with this article. For example, half as many homes listed in July of this year compared to July of 2019. 29% fewer listings entered the market than is typical for this time of the year prior to the pandemic. Right now, homes that went pending in July did so in 12 days, half the time as 2018 and 2019. So for prospective buyers, what's the lesson here? Waiting for lower rates will be offset by higher home prices because of the pent-up demand. So even when we see interest rates falling, which we are still expecting are going to happen, don't expect that is going to be a strong influence on pushing prices down. I continue to argue that there is so much pent-up demand that even with home prices going up, and if interest rates start to drop, home prices are going to go up even further. So I'm not sure you're doing the best thing for yourself to be waiting for for interest rates to drop, thinking that that's going to be a better time to buy, because you may be looking at a much higher price on the home. So if you're a homeowner, this is great news. You've already got a lot of equity in many cases. If home prices jump, as Zillow is predicting, by 6.5% by this time next year, you're going to have even more equity. And if rates do fall by that point, maybe that'll spur you to put your house on the market. But again, if you do, there's so many buyers out there, you're not going to see a case where home prices are going to drop much at all, even with those lower rates. So I just thought that would be an important thing for you to know. There is continued predictions that home prices are going to continue to be firm and likely tend to rise rather than fall over this next period of time. And now I wanted to talk about another news feed I saw earlier this week, and it's about Dave Ramsey again. And I'm not, by the way, picking on Dave Ramsey. I think generally speaking, his advice is very good. I'm all about reducing your debt, saving money, and all those kinds of things. But this headline really, again, caught my attention, like the other one that I had on the program here a week or two ago. And here's the headline from Dave Ramsey: "Renting is not a waste of money. Mortgages, student loans, and 5 other things to actually avoid." Now, the "oh really" part is my snarky add to that headline, and this was in the Go Banking Rates on August 28th. And here's the premise of the article from Dave Ramsey in regard to renting not being a waste of money. He basically suggested that you should continue to rent until you're financially able to buy a home. And that's because housing is an essential expense. Well, of course it is. Everyone needs housing. And so in that regard, it is an essential expense. And he further suggested that you should pay off all your debts and save up a large amount of money for a down payment first before you buy a home. But that struck me as interesting because if you recall, not too long ago, a few weeks ago on our program, I had mentioned that Go Bank Rates had another article that pointed out the average household will take more than 15 years to save up for a 10 to 20% down payment. And they featured 6 different cities in California where that would be the case. And that's a pretty sober statistic in relation to what Mr. Ramsey is suggesting, that you should save up a lot of money for a down payment before you buy a home. It's a challenge. In fact, I would argue that probably the biggest obstacle I run into, and most anybody that does what I do run into with a prospective home buyer, is lack of down payment. And the article further went on to say, when you buy a home, you should pay cash if possible, or take out a very small 15-year loan. Again, is that reality? I'm not so sure. The idea is it's going to help you avoid unaffordable mortgage payments and high interest charges. Of course it would. A 15-year loan is going to save you money on high interest charges because it's a shorter term, and the interest rate on a 15-year loan generally tends to be higher or to be lower. However, in terms of mortgage payment, the payments are higher. And of course, as I pointed out, pay cash, that's not realistic for most home buyers, particularly not a first-time home buyer. And so in that regard, it's just an interesting suggestion by Mr. Ramsey that you should wait to buy a home until you're able to pay cash or provide a very large down payment and then get a 15-year loan that's got, on average, a 33% higher monthly payment than a 30-year fixed. I'm not sure that's a realistic goal, to wait until you can save up a substantial amount of money or actually save up enough to pay cash for the home. The other thing he mentioned was avoid ARM loans due to the higher future interest rates. Well, true to some degree, but what that suggestion, I think, misses is that most ARM loans today are what we call hybrids or fixed ARMs. You're going to have an interest rate and a monthly payment that's going to be fixed on average from 5 to 10 years. So the most popular ones are 5-year arms, 7-year arms, 10-year arms. That means the interest rate and the payment are going to be fixed for that fixed period of time, 5, 7, or 10 years. And if you remember, again, on the program here not long ago, I had mentioned program length. The average mortgage, certainly in California, has a life of less than 10 years. So an ARM loan is not one to avoid necessarily. What you want to do is look at an ARM loan if you're pretty certain you're not going to have that loan or maybe that home beyond the fixed period of the ARM loan. And in fact, the most popular ARM loan that's made today, I would argue, is the 7-year ARM. That's one where the interest rate and the payment are fixed for 7 years. And so most borrowers who get that type of loan are generally thinking they're likely not going to have that loan past that 7-year fixed period, either because they already know they're going to be moving, they're not going to keep the home that long, or they're betting on the fact, which right now I think this is a good bet, that interest rates over that 7-year period likely will go down. And when that happens, they can then look to refinance into either another fixed ARM or maybe more likely a fixed rate loan like a 30-year fixed or maybe a 25 or 20-year fixed. So that's really why an ARM loan is generally not such a bad idea in the right circumstance for the right kind of borrower who understand how it works and who's made some decisions about how long they think they're going to keep the loan or the house, and try to establish a situation where they're not going to keep that loan past the fixed rate period. The other thing that the article pointed out, which I thought was interesting, is he said, avoid FHA loans because they have lifetime mortgage insurance. Well, as of course I pointed out on our program here not long ago, FHA, I think, is probably the greatest loan program the country's ever created, the U.S. has ever created. And yes, there is mortgage insurance on it, but I've pointed out in the past that there's many benefits that are associated with that mortgage insurance in terms of helping first-time home buyers get financing, which even though that's not the case that you have to be a first-time home buyer to get an FHA loan. I pointed that out many times. Plus the fact that he's not totally accurate about they have lifetime mortgage insurance. If you put 10% down or more on an FHA loan, the mortgage insurance does drop off after 11 years. So from that perspective, I would not agree that you should avoid an FHA loan. And in fact, if you're looking to buy your first home, or if you have low to moderate income and maybe you're a little bit more credit score challenged, FHA, in fact, is a great option, and I think actually your best option. So from that perspective, I would disagree with Dave Ramsey about avoiding an FHA loan. And then the other thing about the article overall that I found interesting was that, as many of you may know, rents are at an all-time high. I mean, the median rent in California is nearly $3,000 a month. But interesting, if you're paying $3,000 a month rent, even at current interest rates, you can get a $500,000 loan and have a principal and interest payment that's going to be right in that level of $3,000 a month. And of course, you're going to have taxes and insurance added to that. But the point is, rents are at an all-time high. Rates are high, but given that's the case, it's really something you should look at to determine what kind of loan amount you can get, what kind of price level can you purchase at compared to where today's rents are, to determine if it makes sense to keep on renting, whereas you could be looking to purchase and then at least have the opportunity, not the assurance, but the opportunity to have that asset, that home, increase in value and start to build equity. So what you want to do as a prospective home buyer who's been renting, don't necessarily go with this advice from Ramsey to keep renting until you've saved a tremendous down payment, because it could take you years and years and years. But take a look at a rent versus buy analysis, and we can help with that on our website. There is a page with calculators, and we have a really good calculator that provides you the tax benefits of buying a home. So if you're a renter, and if you're paying substantially high rent, $3,000, $3,500, $4,000 a month, you're paying so much rent, you could actually be looking to buy a home instead. Go to our website, check out the tax benefits of buying a home calculator, and crunch those numbers, and it can help you decide if paying that rent is really the wise thing to do going forward, or if you really should reconsider and start looking at buying a home. So again, I'm not necessarily disagreeing with Dave Ramsey overall and with his advice about, paying off debt, saving money, and those kinds of things. But I think in regard to this particular article, not sure I totally agree with some of the things he's suggesting, and I thought it would be good to share that with you. Then the other thing I want to go to is something I actually run into pretty often in terms of a prospective buyer who's looking to purchase a home and getting it financed is points. What should happen? What should I do when I'm getting the mortgage? Should I pay points or should I not pay points? Well, first thing I would want to do is maybe touch on an explanation. And again, here's the article that I saw, the headline of the article that I saw, where it said, I decided to not pay points on my new mortgage. This was published in the Ascent just a couple of days ago. And in the article, of course, it points out that paying points is like a prepayment of interest. And that's true to some degree. In other words, what you're doing is you're paying a little bit of money up front in the form of points to get a lower rate. And in general, the average is each point. Well, first of all, each point is 1% of the loan amount, not 1% of the home, the price of the home you're buying, 1% of the loan amount. And in general, on average, 1 point will buy down the rate by 0.25%. In other words, if you're looking at a 0-point rate at 6 3/4, as is shown on our website today, 0 points, 6 3/4 for a 30-year fixed. If you paid 1 point, you're likely going to get a rate of 6.5, 0.25% lower. And of course, by doing that, you're going to have a lower monthly payment and you're going to have a lower interest cost because of the lower rate, obviously. But there's a but, and that is, what's the recapture period? If you're going to pay that 1 point to lower your rate from 6 3/4 to 6.5, how long is it going to take you to recover that 1 point cost from the lower monthly payment at the lower rate? And again, this brings up that other issue that I discussed in my program here a week or two ago. Remember mortgage length. If you sell or refi before the interest savings add up, you'll end up being worse off by paying points. And I would argue at current rate levels, if you are looking to buy a home at current rate levels, the expected future refi opportunity in most cases will probably undermine the strategy of the borrower paying points. So you really have to focus on that. Understand that if you're going to pay some points to lower your rate and your payment, how long is it going to take to recover that point cost? So the lesson here, a couple of things. One is, I usually suggest to people, the borrower who's purchasing the home, don't pay points yourself to buy down the rate. You're better off instead negotiate to ask the seller to pay some points to get the lower rate. Or if you're not thinking that that's going to be an option and you're still interested in paying points, again, go to our website. We have a calculator on our website that's called Should I Pay Points? Go to that calculator. You can plug in your numbers, and that will give you an idea of what the recapture period is if you do decide to pay points, so you can make a more informed decision if you can make a more informed decision about paying points or whether or not maybe you shouldn't pay points because the recapture period may be too long. So that's the point there. Either negotiate a seller credit, use our calculator. That way you can make a better decision about whether to pay points or not. But again, in this environment, if you're going to get a mortgage to buy a home when we're in the sixes, and given the very common forecasts that are occurring now that rates are going to get better, I would suggest you might want to there. And Jeff just pulled up our calculator page there. He's showing you where that calculator is. So take a look at that. In fact, a lot of these calculators on here, they're all great calculators. So I would encourage you to take a look at that page and play around with many or all of them, or at least the ones that are more suited to your particular situation. So that's all. That's the story about paying points. My general advice is avoid doing that unless you're pretty adamant, you're pretty sure you're going to be in the house a long time, you're not going to refi the loan. Generally speaking, you want to keep that loan 4, 5, 6 years or more before you're going to recapture that cost. So if that's the case, then it might make sense. And by the way, check with your tax advisor. If you're paying points, particularly on a primary residence transaction, you may find that that's tax deductible in the year that you paid those points. But again, disclaimer, check with your tax accountant to find out for sure. So that's the subject of paying points. And now we'll move on to the closing question from last week. Is it acceptable to get a loan for the down payment? Well, the answer is it depends on the type of it depends on the type of loan. When you're borrowing money for the down payment, loan programs will allow that. And what I've done here is I provided you the guidelines from Fannie Mae for sources of down payment, and borrowed funds secured by an asset are acceptable. Now, what does that mean, borrowed funds secured by an asset, or we also sometimes call it secured borrowed funds? Well, believe it or not, if you've got a car that doesn't have a loan on it, you can refinance that car and take a loan out on it and use it for a down payment. You can get a loan secured by artwork, collectibles, real estate. Of course, that's very common. You can get a HELOC or a fixed rate second. That can be used as a source of down payment to buy another property. You can borrow against financial assets, savings accounts, CDs, stocks, bonds, and 401ks. In that regard, those financial assets, the most common borrowing I see is when you borrow against your 401k or when you borrow against an investment portfolio. If you have a stock and bond portfolio, you can borrow against that. Oftentimes it's referred to as a margin loan. You can borrow against that financial account and use that money as a source of your down payment. Now, if you're borrowing against an asset like autos, artwork, collectibles, real estate, when you borrow that money, the monthly payment that results from that borrowing is included in your debt ratio for the mortgage that you're getting qualified for. So that's important to note. It's not just a question of you can borrow the money against a house you already own and then use that to buy another house and ignore that new obligation that was created by that HELOC that you took out on your current home to buy the other home. That HELOC payment will be included in your debt ratio. Now, if you're borrowing against a financial asset, you're borrowing against a stock account or more commonly a 401k, that monthly payment that results is not counted against your debt ratio on the home that you're purchasing. So that's an important point. If you're borrowing against financial assets, the monthly payment that results is not considered when you're qualifying for the mortgage on the home that you're purchasing. So that can be a pretty good benefit. What is very clear, though, is credit cards and unsecured personal loans cannot be used for down payment. That's a big no-no. You cannot use credit cards. You can't go get a personal loan from a local bank or credit union and use that as a source of down payment, even if you did count the monthly payment that results on that loan in your debt ratio. You just cannot borrow on an unsecured basis as a source of down payment for a home purchase. Now, it is possible to use a credit card to pay common fees outside of closing. That is okay. Now, and you can do that up to 2% of the loan amount, which is a pretty high threshold and almost never gets reached. But what does that mean? Well, what that means is you're buying a home, you're getting a loan, the loan's in process, and you've got to pay for the appraisal, which usually has to be paid for up front when it's ordered. Well, with most lenders, we don't, by the way. With most lenders, they're going to send you a credit card link and ask you to pay for that appraisal at time of order. That's okay. Even though that appraisal is part of your closing costs, it is okay to use a credit card to pay for that appraisal. That's not going to violate the no unsecured loans when getting a mortgage rule. So credit cards being used for fees associated with getting your purchase money loan can be done as long as it doesn't exceed 2% of the loan amount. So there's your detailed answer on can you use a loan for the down payment on the purchase of a home. The answer is yes, depending on whether it's borrowed against a secured asset or a financial asset, or if it's unsecured borrowing, which of course is not allowed. So with that, I'm going to go into our closing question for next week. And it's, I think, pretty appropriate right now. I'm a renter looking to purchase a home for $600,000. How can I determine the tax benefit of purchasing the home? Well, ponder that, think about it. We'll give you the answer next week, which will be on the house. You'll be interested, I think, in learning the answer to that. So with that, Jeff, back to you.
Art, great news today. A lot of good, a lot of like green lights out there. As you were kind of explaining this whole thing about Dave Ramsey, all I could think about is like, should we still go to Dave Ramsey for financial advice when it comes to buying a home? It sounds like maybe, he's using some metrics. And again, I say this with caution, but is he using today's metrics to give advice to people making a decision?
Well, yeah. I mean, what I find interesting about, again, I'm not against Dave Ramsey. I think generally speaking, his advice is good. It's valid. I mean, people, and I see it from from what I do for a living. I mean, people have too much debt. Credit card debt is exploding. And a big part of his focus is that situation, that people have way too much debt. You need to pay that off. You need to figure out how to save money. Those are all good messages, and I fully support. But I think to some degree, and I think a lot of this has to do with, it's the old story of what we talked about in this program before. Beware of the headlines. And I'm noticing a lot of Dave Ramsey articles are, hitting the news feed. And in a lot of cases, I think maybe it's just the headline is being written in such a way to kind of create clicks and create attention, but kind of are not realistic. And when it comes to, if you buy a house, you should pay cash, or if you buy a house, you should save up a very substantial down payment and go with a 15-year loan. That's just not reality. 15-year loan's a great option. Nine times out of 10, when I have somebody come to me and say, "Oh, I want to go with a 15-year loan because I hear that's a better rate," so I give them the numbers. 9 times out of 10, they pass. Why? Because the monthly payment is a lot higher. It's about 33% higher than a 30-year fixed. So particularly if you're a first-time home buyer, and if you're listening to Dave Ramsey and he says, well, you should pay cash for the house, or you should save a substantial down payment and go with a 15-year loan, you're basically telling that first-time home buyer, you're not going to buy a home for decades because it's going to take you that long to save up enough money to pay cash or to put a substantial down payment for a 15-year loan. It's just not reality. And so I just wanted to make it known that you do have options. And in that particular arena, following Dave's advice may not be the best for your situation.
Yeah, I love the fact that you cleared that up. And again, you didn't throw Dave under the bus, but you did say, hey, here's the other side of that coin. And it goes back to many, many weeks ago, you said, hey, beware of the headlines. Right. And, what's really in the depth of the story and what's going on there. And you pointing things out like, hey, the average, when you talked about the Schiller report and it, average home prices since 1975 have gone up 5.5%. And then the struggle that people have to actually save money. And if it takes 15 years, I don't honestly see that they'll ever be able to buy a home at those two numbers. Is that wrong to say that?
No, I don't think so. Not at all. And that's what I found a little frustrating with the Ramsey headline about, renting's not a waste of money and you should avoid certain mortgages. Is like, well, wait a minute. FHA in particular, even though it's not for first-time home buyers, that's not a requirement. That's the program used probably more than any other for first-time home buyers because it gives you the opportunity to transition from being a renter to being a homeowner with a low down payment, not a substantial, not a 15-year loan. You can get a loan with a low down payment on a 30-year term, and you can qualify for a pretty good loan amount because the debt ratio allowance is higher. It's an avenue to get into home ownership, and it doesn't require that you save money over 15 years in order to get into home ownership. So I just think that's an important message to get out, and don't feel like, because one of the things about the Ramsey article when I saw it was I felt like it perpetuated that notion that you got to have a 20% down payment to buy a home, or more. And that's a fallacy. That's just not true. And I think it keeps too many people who are renting from really focusing on the opportunity to own a home sooner than later. So I just I wanted to react to that article and let the audience know you have other options. And the option that Dave's suggesting, while I guess is valid and is, I think it's kind of idealistic, and I just don't think it's realistic for most families. So.
Well, one thing, and then I'll let us wrap up here, is one thing I love what you pointed out. It said, hey, if you are renting at the median prices, just the median prices, not the high, but the median prices in the state of California, you could actually get a home priced at $500,000. I mean, that's a lot of house still, even with the prices going up. There's a lot of homes out there. I've noticed that there's a lot of homes, even in the area I live in, that, you're starting to see the prices in the fours. And so you can get a lot of home for that. And again, all the tax benefits that you can, and again, I'm not a tax consultant, but as a homeowner, that you can derive from owning your own home versus renting. I think that's great information.
Yep. That's right. It's as I pointed out in a meeting I was at the other day, if you're paying $3,500 a month in rent, well, heck, if you got $30,000 or have access to it, 401k loan, maybe a gift from a family member, if you're paying that kind of rent, you can be buying a home for $529,000 with a 5% down payment and having a similar housing expense with the tax benefit of the mortgage interest deduction and at least the opportunity of owning an asset that, if Zillow is right, will appreciate in value and build more equity for you. So,
yeah. Great sound advice, Art. I really appreciate it. Thanks for coming on again today and sharing that information. I want to point out that, if this type of stuff does what it does to you, it makes the hair on the back of your neck stand up and said, hey, maybe I should take action now. And I'll take advantage of some of the rates, especially now that they are going down. They're going down and stabilizing a little bit. You want to reach out to Art. You can get him in his office at 760-883-5700 or always on that cool little flip phone that he has at 714-612-9035. He is ready to go into action for you. He's like a superhero. If he pulled his shirt open, there'd probably be an S on there because he's a Superman when it comes to putting mortgages together. Art, I really appreciate you being here today. And again, if you have questions or comments, please put them in the comment section, and Art will get back into it. Have a great weekend and be safe out there. It is a holiday weekend, so enjoy it. And Art, we'll see you on the other side.
Okay, thanks, Jeff. Thank you, everyone. Thanks for listening. Thanks for watching. My name's Art Alvarez, where I'm with MortgageWorks, where we have the answers and they're on the house. So take care and have a good weekend. Take care.